Now, consolidation of financial statements, and this is a financial reporting question, somewhere in May 2021, question 5. Now, on 1st April 2018, Ambaza Limited acquired the following financial statements. So the following financial statements were acquired. 1,320 equity shares in Rudisha Limited at a cost of 27,300 when the retained earnings of Rudisha Limited stood at 12,500. Now they also acquired 50% of Rudisha Limited's 12% debentures at par. So 50% of Rudisha Limited's 12% debentures at par. The statement of financial position of the two companies as at 31st March 2020 were as follows. So we have Ambaza and Rudisha, and we also have the additional information. The fair value of Rudisha Limited's asset at the date of acquisition was equal to their carrying value, except for an item of plant which had a fair value of 1.6 in excess of its carrying value. Now, the plant had a remaining useful life of 4 years. On 15th March 2020, Rudisha Limited sold goods to Ambaza Limited for 700,000, all on credit terms. The goods had not been received by the company as at 31st March 2020 and were not included in the closing inventory. No entry had been made in the books of Ambaza Limited. So no entry had been made in the books of Ambaza Limited. As at 1st March 2020, the accounts payable of Ambaza included 750 due to Rudisha before taking into account the above transaction. Ambaza Limited had not accounted for dividend receivable from Rudisha. Goodwill arising on acquisition of Rudisha Limited was considered impaired by 20% on 31st March 2020. The fair value attributable to NCI amounted to 6,800,000. Required, they want the consolidated statement of financial position as at 31st March 2020 for these two companies. So solution, our solution here, our solution. Solution, and we have a title. We pick the currency. When you have our workings on the other side, we have our workings here. Workings. Now the first working is percentage of ownership. So we want to talk about the percentage of ownership, and not one, percentage of ownership, the percentage of ownership. Now percentage of ownership and shares acquired, number of shares acquired, in number. So the number of shares acquired amounted to a number of shares acquired. In the opener of the question, they acquired 1,320. This is 1,320 shares. So you get the 1,320. You can use 1,320,000 if you want. Then total number of shares, total shares in R Limited, So the total number of shares in R Limited are, if you go to the statement of financial position, we have 16,500. Divide that with the par value, which is 10. So the par value is 10. So 16,500 divided by 10. And percentage acquired, therefore, the percentage acquired will be division of the two. So you simply take 1320, divide that with 1650, and you're going to get some percentage, which is 80%. So we have 80% as the NCI we know that NCI, now the non-controlling interest. Now NCI is equal to 20%. That is just 20%. NCI is 20%. We also need to know that R Limited has been held for 2 years since 1st April 2018. 1st April 2018. That one has been held for 2 years since 1st April 2018. Note 2, fair value adjustment. Note 2 will be fair value adjustment and additional depreciation. Fair value adjustment and additional depreciation. So according to note 1, they are saying that the fair value was 1.6 in excess of carrying amount and the remaining economic useful life was 4 years. So 1600. So this will be the fair value adjustment. Fair value adjustment. Now the fair value adjustment is 1,600. So 1.6. Then additional depreciation due to fair value adjustment. So additional depreciation due to fair value adjustment will be equal sign 1,600 divided by remaining useful life of 4 years. So divide that with 4. But at the back of your mind, you need to multiply with 2 years because it has been held for 2 years. At the end of the day, you multiply with 2 and get your additional depreciation of 800. So note 3, goodwill computation, full goodwill method. So use full goodwill. Why? Because additional information number 6 has given us the fair value attributable to NCI. So you can see that we have fair value attributable to NCI. So we use the full goodwill method. That means that consideration paid will be equals to consideration paid. Now they acquired at 27,300, so it amounted to 27,300. Consideration paid 27,300. Add fair value attributable to NCI. So the fair value attributable to NCI. Additional information number 6, 6,800. So 6,800. That is 6,800. Sum up, then less the fair value of identifiable net assets. So fair value of identifiable net asset, which will be equal sign the ordinary shares. Copy down. We have ordinary shares and retained earnings. This one will be using ordinary shares of equal sign 16,500. So that is 16,500 for R Limited. Then pre-acquisition profits. The pre-acquisition profits. Now those who are in the opener of the question, the pre-acquisition profits amounted to 12,500 when the retained earnings were 12,500. We're going to use 12,500 12,500. Don't multiply with the percentage owned because you're using the full goodwill method. You simply sum what we have here. Now, I've forgotten one item, the fair value adjustment. So there is fair value adjustment, fair value adjustment, the fair value adjustment, which amounted to 1600. So fair value adjustment was 1600 as our answer. Fair value adjustment. Adjust the summing. And we have what is supposed to be deducted, which is 30,600. So that will give you goodwill of 34,100 plus 30,600, and goodwill is 3,500 to the consolidated statement of financial position, unless it was impaired. So we check for any impairment. So it is impaired by 20% on that 1st March 2020. So 20%. That was impaired by 20%. So impairment at 20%. So the 35 times negative 20%, 700, to give you a summation of goodwill to the consolidated statement of financial position of 2,800. So that will be goodwill to the consolidated statement of financial position. The first item, after this, we can move to preparation here, and we have assets. Assets. We start with the non-current. We start with the non-current. Then after non-current, the first asset is property, plant, and equipment. Now look at property, plant, and equipment. That will be our first item. Now property, plant, and equipment will be, PPE will be equal sign, PPE of Ambaza, this is the PPE of Ambaza, plus PPE of Rudisha, plus fair value adjustment of 16. So we have fair value adjustment of 16 minus additional depreciation of 800. So the additional depreciation of 800. So you must deduct all those elements. So you add the one for Ambaza plus the one for Rudisha, add the fair value adjustment, then you less additional depreciation, and it gives you 62,160. That is property, plant, and equipment. Now from property, plant, and equipment, we have investments. So we also have, before investment, we can talk of goodwill. Now goodwill will be equal sign, then pick this goodwill, which is 3,000, not 3,000, by 2,800. So goodwill is 2,800. Enter. That is goodwill. Go for investments. Investments are here. Investments. Now investments are equal sign. Take investments for Ambaza plus the investments for Rudisha, less, you deduct from that, you deduct consideration paid. So the consideration paid of 27,300 is part of the investments there. So you less the consideration paid, that will give us 3,100. There's something that we've not included here. There's something that we've not included on investments. So on investments, you also deduct, remember, they also acquired 50% of 12% debentures. 50% of 12% debentures. So you can put in bracket what is 50% of debentures, in bracket, then 50% times, so minus 50% times the debentures of Rhodesia, which is 2,800. That will amount to 1,400. So we are also deducting the 1,400. So take the investment for Ambaza plus investment for Rhodesia minus the consideration paid of 27,300, then minus also the half of 2,800, which is 50% of 2,800. That is 28,700. Total, alt equal, and the total is 93,660. So we have 93,660. Current assets. Current assets. So we'll start with inventory. I hope the inventories are affected. So we want to deal with things that affect inventory. So inventory, there is additional information number what? 2. Rhodesia Limited sold goods to Ambaza of $700 on credit. The goods had not been received by the company as of 31st March and were not included in the closing inventory. No entry had been made in the books of Ambaza Limited. As at 31st March, the account payable of Ambaza included $750 due to Rhodesia before taking into account the above transaction. So do we have any, there is intercompany sale, but do we have URP? Anything to do with the URP? Yeah, there is something hidden here. We can just expand this. There is something hidden on that. There is something hidden. So no entry had been made in the books of Ambaza Limited in respect of this transaction. Rhodesia Limited sells goods to all customers at a standard markup of 16 and something. 16, so we have to, I think it was 16,2/3 if I'm not wrong. 16,2/3, but we'll be confirming that. 3. So this was 16,2/3%. So 16,2/3%. 16,2/3%. This transaction looks like Rhodesia sold to Ambaza. Rhodesia is the subsidiary. That is an upstream transaction. I want us to deal with that in the workings before we can move forward. So that is note 4. Note 4. Intercompany sale. Intercompany sale and URP. Intercompany sale and URP. Ambaza, not Ambaza, but R Limited sold to A Limited. R Limited sold to A Limited. And what is the price of the goods that were sold? 700 on credit. So that is 700 on credit.
Hey. Sorry.
So if markup is 16,2/3, what is margin? If markup is 16,2/3, what is margin? Now margin will be, simply take, margin will be 3 times 16. What is 3 times 16? 3 times 16, what is that? Is 50/3. This one also translates to 50/3 if you want to put this in another way. This one can also be written as equal sign 50/3. 50/3. Then 50/3%. By the 50/3%, or can put that in bracket, 50/3%. So 50/3% will give you which figure? 16.67. I wanted that to, what if we convert this to fraction? We want a fraction, 1/6. So if you convert this to fraction, it's 1/6. So margin is 1/7. 1/7. After getting the margin, what is URP? URP, now remember, the goods were not received by the buying company. That tells you that all the goods were still in the inventory of the buying company. The goods were still in the inventory of the buying company. Nothing had been sold to outsiders. Therefore, URP is equal sign 700 times 1 over 7. So 700 times 1 over 7, which will give you 100. So URP will be 100. 100. So URP is 100. Now, since the goods were still on transit, they will be added to the group inventory. Since the goods were on transit, so not goods on transit are added to group inventory. So they are assumed that they were received. So you simply add them to group inventory. That is what we are going to do as we get our group inventory. Now, for when getting group inventory, you add the goods on transit, then you less URP. You must also deduct URP as we have it there. So current assets, we have first one being inventory. Inventory. And inventory will be equal sign 6350 of Ambaza plus 5200 of Rhodesia. So 6350 of Ambaza plus 5200 of Rhodesia minus before minusing you add plus 700, which is the goods on transit. You add the goods on transit, then minus the URP of 100. You also deduct the URP of 100. Now that will give you the final answer, which is 12,150. That you do equal sign for group inventory. You take the one for Ambaza, which is 6350, plus the one for Rhodesia, which is 5200, plus goods on transit, which are added to inventory, which is 700, then minus the URP, which is 100, and you get your final answer. Now, accounts receivable, and they said, as at 31st March 2020, the accounts payable of Ambaza Limited included 750 due to Rhodesia before taking into account the above transaction. That was before taking into account the above transaction. So the payable of Ambaza had 750 due to Rhodesia before taking into account the above transaction. Now, if you take into account the above transaction, then the intercompany balance will now be increasing. So let us adjust that here in note 5. Note 5, the intercompany balance, existing is 750. So existing is 750. Then transaction unrecorded. We also have transaction not recorded in payables, not recorded in payables. Transaction not recorded in payables will be the one that is having 700 here, the goods on transit. Remember the goods on transit, the purchasing company had not recorded. You record that, that will be taken to payables, and now you have a total intercompany of 1450. But remember, it had been recorded already in receivables. So this one already is in receivables. The only place that it's missing was in payables. The group receivables will be equal sign take 4360 plus 1950, then less intercompany balance. Now the intercompany balance that exists today is 1450. 1450. That is the intercompany balance of 1450. You less the intercompany balance. That is accounts receivable. Then bank Bank will be equal sign. I saw an overdraft somewhere. Bank 1390 minus, so 1390 minus, there is a bank overdraft of 1950. 1950. That one is a negative, so leave it. Don't record that because it's a bank overdraft still. It's a negative, net negative. So leave it. Get your total. This will be total assets. Total assets. Not total assets, but total current assets. Start with current assets. Alt equal to get at 17,010. Then total assets are 93,660 plus 17,010, which gives us 110,670. 110,670. On to the next, which is equal sign, equity and liability. So we also have equity and liabilities. Equity and liabilities. So start with equity and reserves. Equity and reserves. Ordinary shares. Ordinary shares. Then you also have retained earnings. We'll be using some retained earnings. Retained earnings. Ordinary shares doesn't change. So the ordinary shares are 43,000. Now retained earnings is going to be calculated. This will be non-controlling interest. Non-controlling interest. Non-controlling interest. Now we start with group retained earnings, note 6. The group retained earnings. Group retained earnings. Group retained earnings. Group retained earnings, and start with the A Limited retained earnings. A Limited's retained earnings, those are taken in full. The A Limited retained earnings, that is the parent company's retained earnings. So parent company's retained earnings. What were the parent company's retained earnings? Parent company's retained earnings. 34,560. 34,560. 34,560. Post a share of post acquisition profits in R Limited. Post acquisition profits in R Limited. Share of post acquisition profits in R Limited. Bracket, equal sign bracket. Then move up and find the retained earnings of R Limited, which is 8190. 8190. Total retained earnings is 8190 minus pre-acquisition retained earnings. Now the pre-acquisition retained earnings were 12,500. 12,500. You can see you use them in computing goodwill. Goodwill is here. When you computed goodwill, you used some 12,500. So deduct that. Close bracket. Close bracket. Times what you own. So you own there only 80%. Times what you own, which is 80%. Now it gives you 3448, which is a negative. There was additional depreciation. Additional depreciation. Remember additional depreciation, parent share. So additional depreciation parent share will be parent share, be equal sign, move up and find additional depreciation, which is 800 times 80%. So 800 times 80%. That is 640. This is supposed to be deducted. Equal sign negative. So 640 is deducted. URP on inventory. URP on inventory, again the parent share because it was upstream. Because it was upstream, then the parent share will be equal sign URP on inventory, somewhere here, 100 times 80%. So 100 times 80%. 100 times 80%, it's a negative, equal, that is 80. Remember, it was upstream transaction. Apart from, we also have impairment of goodwill. Impairment of goodwill. Remember, the impairment of goodwill was a full goodwill method. It means NCI will also have the share. That is equal sign. The impairment was 700. This is 700 times you take the parent's share, which is 20%. 20% parent share. Not 20, but 80. 80. So 80. Parent share is 80%. It's already negative, you don't negate again. So impairment of goodwill is 560. 560. So it is the 700 times 80%. Now after that we also have dividend. We revert back the dividend. There was dividend that was paid unless there is something forgotten. There is dividend. Dividend. Ambaza Limited had not accounted for dividend receivable from Rudisha, but you can see Rudisha has put some dividend of 1,200. So this dividend of 1,200, you simply cancel from the proposed dividend. So you cancel by debiting proposed dividend and crediting the retained earnings. So it's like you're reverting them back from the profits of the group retained earnings. So you're going to debit the proposed dividend and then credit the retained earnings. So the proposed dividend, those are added back. You revert them back, will be equal sign. The parent share is 80%. 80% times 80% times the proposed dividend amounted to 1,200. Don't negate because we are adding back to the retained earnings. They had been deducted from R Limited's profit, but you cancel by just reverting them back. Get the total. Understand. Now this will go to the consolidated statement of financial position, and that will be a consolidated statement of financial position. This 3792. I'm getting 3792. Yeah, 3792. 3792. Summation of all that. So you deduct all this, except that we add 960 for the proposed. Now retained earnings. Retained earnings will be equal sign. Click on 3792. 3792. Then we go to non-controlling interest, another working. Non-controlling interest. That is not 6, if not 7. That will be not 7. Not 7. Not 7, non-controlling interest. Now NCI was measured. So fair value of NCI at acquisition. The fair value of NCI at acquisition. Fair value of NCI at acquisition is equal sign. Go to where you computed goodwill, and you will see that it was 6,800 where you computed goodwill. 6,800. Then there is this, all these things, by the way, all these things will move here, all of them. So copy paste. So NCI share of post-acquisition profits in that other company will be, I want to copy the same for the same cell here, Control C, then Control V. It's not working unless I had locked. So just do equal sign, share of post-acquisition retained earnings, then bracket, post-acquisition retained earnings, take 8190 minus the profit that you used to compute goodwill was 12,500 plus, then multiply that times 20%. Now it takes times 20%, the NCI share of that. Same thing, but now it's 20%. Additional depreciation, 20% of 800, so 800 times negative 20%. I want it to be a negative because it's deducted, it's 160. URP on inventory, will sign negative. 100, remember it was upstream, times 20%. That gives us 20. Now, this one is included here because it is upstream. Upstream. If upstream, then this one is here. We usually say that if full goodwill method, and indeed it was full goodwill method, that will be equal sign, go to goodwill, take the goodwill, which is 700, just multiply with 20%. That will give us 140. So for impairment, we usually say that if full goodwill, if full goodwill, if full goodwill. If full goodwill. Now proposed dividend, you also take the NCI will take its share. For proposed dividend, just take the other share to NCI for proposed dividend. That will be what you have here as 1200. 1200, the proposed dividend, times 20%. 20%. Or it can be retained there, let's see, 240. You can take that, the amount owed to NCI. Let NCI take its share, that we only remain with proposed dividend for the parent company. Anything else that affects NCI, this one will go to the consolidated statement of financial position, alt equal, enter, and it is 58, 58, 58, 58, 58, 58. Now NCI is 58, 58. This will be NCI equal sign, then pick 58, 58. 58, 58. Total shareholders funds. Total shareholders funds. $79,650. 79,650. After 79,650, we have non-current liabilities. And non-current liabilities were affected by intercompany loan. We have something there for, there is this first one, 12% debentures, nothing affected 12%. Now something affected that. We also have deferred tax. Now for 12% debentures, you will simply take 8,200 plus 2,800, but minus. You're supposed to deduct half of the debentures that were acquired. So minus, open bracket. Can it take again 28 times 50%? Let's see. Times 50%. It may refuse to, okay, 9,600. So you see they invested in half of the debentures. So it is 82 plus 28 minus then 28, and you remove the 14, the half investment. So 82 plus 28 minus in bracket 50% debentures that were invested in. So that is 9,600. Deferred tax 3909 plus 1200, that is 51 and 5109. So to get a little space, you can write insert, select and then insert. Current liabilities, accounts payable, taxation, dividends, bank overdraft. I think first I need the total of non-current. Now the total of non-current is 14,709. Then accounts payable will be equal sign 5710 plus 1760 plus, so don't forget the transaction that had not been recorded. Don't forget the transaction that had not been recorded. Which transaction? The transaction about the goods in transit not recorded in payables. Transaction not recorded in payables. So this transaction not recorded in payables, add the 700. So those two plus 700, which was not recorded, then minus now the intercompany balance of 1450. The intercompany, once you record it, it creates an intercompany balance totaling to 1450, which will be eliminated in full. Taxation, that is quite easy, because for taxation you simply pick 5330 plus 2410. Dividends, you only pick one. For dividends, you now only pick one. That will be equal sign 1300. The other one, we cancelled by taking an amount to retained earnings. The NCI share was taken to NCI. So this is just 1300. Just use the 1300. Bank overdraft. Bank overdraft, we have 1390 up there plus 1390 plus 1950. It should be minus 1950 minus 1950. So 1350 minus 1950, they are getting 560. Or it should be a positive figure, not a negative. So it should be equal sign. Start with the 1950 minus 1350. 1950 minus 1390, I mean. 1350 minus 1390. 560. Add 16230. 16320. 16320. Then this will give you total equity. We can total equity, I can just pick this, total equity and liabilities. Total equity and liabilities. The other one should also be just total assets in small letters, they say. Now this will give you equal sign 79,650 plus 14,709 plus 16,320, which gives us 110,679. 110,679. What happened there? So this is a 110,670, but the other one is 110,679. Now the 9 comes from deferred tax. They are saying 5109. Deferred tax on the other side is 3909, but looking at the original PDF, maybe when converting PDF to Excel, it was distorted. There are those things that are distorted with these online conversion tools. So going to the original PDF paper for the same question, the original PDF paper for the same question, we can see that the deferred tax is 3,900, not 3,909. So 3,900. So change this to 3,900 from the original part. 3,900, enter. This becomes 12,100 and now balances at 110,670. It changes this to the correct value and it now balances at 110,670. So that was consolidation of financial statements. And this question was FR. So this was financial reporting, May 2021, question 5. May 2021, question 5. CPA. CPA. That is our final solution. You can see from where we started. The title is not visible. The consolidated statement of financial position alongside the workings. And the workings extended to note 7.